And thank you, Marty, for this great opportunity. David, wonderful to hear about your firm and all the great things that you're doing, particularly in the tax area. It's of particular interest to me. Good morning to everyone. And my name is Mark Heil. I'm Institutional Sales Manager for Pacific Premier Trust, a division of Pacific Premier Bank, formerly known as Pensco Trust. For those of you not familiar with us, we are one of the largest and most experienced custody providers in alternative assets. Our custody solutions include self-directed IRAs, private fund custody, custody of retirement plans, broker-dealers, securities, and so on down the line. Our clients include individuals, family offices, RIAs, broker-dealers, investment asset sponsors, defined benefit plans. So I think that gives you a pretty good range on who we are. Of course, being part of a bank and having a very good legal department, I have a mandatory disclosure I have to read before I do these things. Information presented is for educational purposes only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You're advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including the loss of principal. So with that now out of the way, let's proceed forward here. We're glad to be kicking off this event here in New York City. What a wonderful town, what a wonderful city. We have a lot of great topics that are going to be presented over the next couple of days. Marty's done a great job. Look at the list of panelists and topics that we're going to be going over: venture, real estate, crypto, private equity. I always, when I come to these, I always learn so much from the other panelists and things that are being discussed. Now, this morning we have a great panel here with me. We've got Danye Wang, who is managing partner of UniGlobe Capital. We have John Caplis, CEO and founder of Pivotal Path. Dagmar Birker, executive director of Novastone Capital Advisors, a Swiss family office. Marty, did she come on yet?
We're trying to chase her down.
Okay. I sent her an email. She's in Zurich, so it should be a little bit of a time difference. I hope she didn't get confused with daylight savings time and things like that. And Jeff Landle, managing partner and chief investment officer of the investment committee for Little Harbor Advisors. So with that, I'm going to ask Jeff maybe just to take a minute or two right now and introduce yourself to our audience and talk a little bit about what you do.
Thank you, and morning, everybody. Appreciate the opportunity to be a part of this prestigious event. I've been in the hedge fund business for more than I'd like to think about. Ran the hedge fund group at Common Fund, spent some time at Blackstone, HBB Group, and created my own investment company with an Austrian business partner. Little Harbor is a group that I've known for a long time, and our focus is really on strategies and managers that either provide uncorrelated returns or if there's a beta component, some measure of potential downside protection. So our model is really a little bit of a hybrid. We will bring managers in-house and help them grow either through the introduction of ETFs or managed accounts. And again, as I said, the focus is really on providing a measure of uncorrelated returns or potential downside protection, as the case may be.
I got to find my headphone here. Where is that mic? Boom. So when you look for an investment manager, you mentioned ETFs and you mentioned hedge funds. So you're looking globally for these?
Our approach is global and always has been. The majority of our strategies are currently US based and US focused, but have looked in Europe, Asia, wherever we can find value, that's where we'll go.
That sounds terrific. All right. Well, I want to next get our next person up here, Danye Wang. If you would do us the favor and tell us a little bit about UniGlobe Capital.
Thanks, Mark, and super excited to be part of IvyFON again, and thanks for Marty's invitation. I will be joining in person later in the day, so if there are people in the audience, I would love to engage with you guys in an in-person manner in a bit. I'm based in New York City. I spent almost 10 years at BlackRock before coming out myself and start UniGlobe Capital about 3 years ago. My work at BlackRock was focused on cross-border, where I manage a lot of relationship with Asian institutional investors, and specifically sovereign wealth funds, central banks, and certain insurance companies. During my career at BlackRock, I also used to run one of the largest educational programs in the industry called BlackRock Educational Academy, which is a program I launched. What was interesting and very relevant to the conversation today is that despite all kinds of institutional investors, as we all know, fund of funds, endowment foundations, family offices being a growing category, there's actually a lot of similarity between family offices and sovereign wealth fund, because most of the other allocators like pension funds, etc., they are allocators in the sense that they really look for fund allocation. But for sovereign wealth fund and family offices, although one is huge in asset under management and family offices is usually more nimble, the decision-making process may be different. But these are the two LP types that, in my understanding, are specifically interested in direct access to deals, opportunity pipeline, and also co-investment. So I think my background at BlackRock was very interesting to what I do now with UniGlobe Capital, because I continued to focus on cross-border, both advising Asian managers across asset classes as well as family offices. Right now, I work with three. One is Indonesian-based, actually one of the largest families conglomerate in Indonesia that has investment footprint across the globe, and they're building out their investment team and kind of an emerging manager co-GP program here in the States, as well as one Hong Kong-based family office who accumulated their wealth through healthcare, and another one that's between China and Hong Kong. But I only advise on their offshore capital, US dollar capital. In terms of asset destination of investment, I would say US and China continue to be the two biggest market that I focus on. I'm a huge advocate for diversity, so I support a lot of women founders and investors, and I also advise a relatively new platform known as Family Offices Connect. It is essentially the Crunchbase of Chinese family offices, and I hope the platform to connect the dots with other global family offices.
Fantastic. Thank you, Danye, for that. Now, I wanted you just to slow down, because you mentioned you work for three family offices specifically, and each one sort of has a little different appetite for the type of deal or type of manager they're looking for. Could you just maybe take each one a little bit and just spell it out so people know where they fit in? And
absolutely. Yeah. My network of family offices is obviously broader than this, but these are three specific bespoke mandate. The first one, as I mentioned, the Indonesian family offices. So their primary interest in the United States is both in real estate as well as technology private market investment. And especially on the private market investment, they're specifically looking for growth stage managers. They can either allocate to a manager, or they can bring the manager on board from with a seeding arrangement, seeding up to 40% of the capital that this manager is looking to raise, but obviously there's going to be a GP stake arrangement. So it's a co-GP model in terms of supporting emerging managers and help them to onboard on their own platform. This is the Indonesian family office. And the Hong Kong-based family office with a healthcare background, they actually have a lot of intention to diversify their private markets asset mix. So their interest in the US range from typical technology to private credit. I'm recently talking to them mostly about private credit or alternative credit type of opportunities. And again, they don't worry as much about track record, but they do pretty deep due diligence and reference checks, and they certainly appreciate mature managers. Even for a first time or second time fund, it needs to be a mature manager from a capability perspective. And the third family office, because the owner made his wealth through tech investment. He was a founder of a significant a public tech company in China. So he himself actually has a lot of direct deal access in technology. So his interest, especially when it comes to US dollar, is more in hedge funds, especially with superior downside protection. But when it comes to Asian family offices, one thing that needs a lot of convincing is that as much as they look at returns, they also care a lot about the reputation of the manager they might be allocating to. So sometimes really small or under the radar managers might be difficult to really break into their network just because they have a tendency of continue to look at some of the brand name managers as their kind of first or second allocation to the US before they expand to more emerging names. But they focus a lot on liquidity as well as downside protection.
Fantastic. Thank you for that. John and I had a great conversation yesterday. John Caplis with Pivotal Path. Do you want to take a few minutes, introduce yourself, tell us about your firm?
Sure. Thanks, Mark and Marty. Thank you for having me on again. It's a pleasure to be back. So yes, I'm the CEO and founder of Pivotal Path, which was launched in 2013. And we're a technology-driven hedge fund consultant. So our core business is really working exclusively with institutional allocators across all verticals, from very large single-family offices across the globe to some of the largest pensions in Europe, foundations, endowments, RIAs, wealth managers, you name it. Anyone who's allocating directly to hedge funds in a significant way, they could be a client of ours. And they're using us to better source, monitor, and evaluate, and really benchmark is one of the key areas in which they leverage our information. And we actually, I mentioned technology driven. We provide research platforms or apps to our clients as part of our relationship with them. And that's one of the ways in which we communicate to them. Our philosophy, which we've been told over the years is quite different than most other consultants, is really the fact that, we ask this one question, and the question is, how can a client of ours make a good investment decision in a hedge fund if they're not even aware of all of the relevant choices? And so, that's why we've built out the most robust peer groups across 40 different strategies across the globe. And the idea is so our clients can really have, not only know the full set of options in which they can evaluate, but be able to benchmark any fund, be able to evaluate their strengths and weaknesses within the context of their actual peers, or meaning the other choices that that investor has. And so, our clients, as they think about us in the competitive landscape, and I mentioned consultants, which we are, think about us between kind of the databases on one side and the large consultants on the other side, where, the database's goals, and not to pick on anyone, HFR, and IvyFON, Eureka Hedge, Barclay Hedge, their goal is to provide transparency and organization within a historically or relatively opaque industry. The one major problem is that a lot of high quality, institutional quality, capacity constrained hedge funds, these types of funds oftentimes just choose not to report to databases. They keep their data close to their vest. They certainly want to protect it, and they only provide it to investors that they believe they have a good shot at raising capital with. And so, that's an area where really any analysis or any index that is created in a data set that has huge gaps, the output's always going to be only as good as the input, right? And so, unfortunately, there are flaws in a lot of the indices that we see in the industry. On the other side of the coin are the consultants, and not to say anything bad about them, but their business model is just quite different. They're not necessarily looking to provide full transparency. They sell advice. And so they're giving a curated view on the world and funds. And what ends up happening is investors, unless they're doing all of the work on their own, they're usually missing out on a large amount of the actual hedge fund information. And again, whether that's sourcing managers, whether that's evaluating them in the right context, whether that's using indices, those are all things we help our clients with. And so our research platform, we cover over 2,300 hedge funds across 40 strategies. More importantly than that, that's close to $2.5 trillion in hedge fund capital. And as a point of reference, that's actually more hedge fund capital and coverage than all of those databases that I mentioned combined. And so what that means is our clients, which comprise over 150 billion in hedge fund capital, it means that they can really systematically, or we help them systematically answer two questions. And you might hear me say this a couple of times throughout because it's really part of every thought process and every exercise we do. It's, does a manager do what they say they do? And do they do it better than my other options? And obviously better is not completely rule driven. It's going to be contingent upon the investor. But given our relationship with all of our clients on the investment side, to all of our relationships with every prime broker from Goldman Sachs, Morgan Stanley, JP Morgan on down, to the over the 2,300 hedge funds that we speak to on a regular basis, and the fact that they also provide us their information, we have a really unique 360 view into the hedge fund industry, both from the bottom up and the top down.
Terrific. Thank you very much. And I understand from Marty, Dagmar has joined us. So Dagmar, why don't you jump in here and introduce yourself and tell us a little bit about Novastone.
Very well. Thank you very much. Thank you, Marty. Thank you, Mark. Thank you, everybody. Greetings from Zurich. I'm joining here from Novastone Capital Advisors. We are a turnkey advisory program to our own family office and to our program members, which are Swiss, international, and today also North American family offices, building private equity direct portfolios with the search fund asset class. And those who are familiar with the asset class do know that this is both a designation of where the capital sits, which is between venture and growth. And it is an investment process whereby you go manager first and you back as a interested family office, a searcher or a manager. And that manager then will embark on searching for a company given the business case or strategy and industry vertical or geographic footprint, and you will support him towards a successful exit. So having said that, the asset class obviously emanates from the US. It's now present in the market for more than 30 years. But for us to be able to capture opportunities in the European market and for family offices, we quite significantly adjusted to family offices' desires or views on managers and to SME owners looking to hand their company off, not to a strategic buyer or to an institutional investor who is mainly looking to increase performance on balance sheet measures, but to managers who are looking to create future value in their company. And this is what we're looking to address here with our program.
Terrific. So you got started in this, what, a year ago, if I recall from our prep session?
Yes. Well, the family office itself has been investing in the asset class for more than 10 years in the States, South America, Spain, and punctually in a couple of other regions. But we decided for Europe to launch a program last summer. So the program is up and running in Europe, and we have stood up the US program entirely digital, I should say, and we have a presence now in Boston. And we have just closed our first cap table for a US searcher. It's a lady searcher, so we're super proud of this. Because lady entrepreneurs or lady portfolio managers, there are maybe 1 in 1,000. So we're up and running, and we're continuously introducing new entrepreneurs or managers, whichever way you'd like to call them, let's say on a monthly basis, both in the North American market and in the pan-European market.
Well, terrific. And thank you very much for that. We're going to really get into this, and we're going to have some more discussion with Dagmar about how this whole search process works and goes. But what I'd like to do is maybe just talk a little bit about, from 2010 to well, I'll say COVID, obviously early 2020, the market was characterized by low volatility, low inflation, low interest rates, and steady growth. Since then, things have changed a little bit, shall we say. We've had, the pandemic come through. We've had a change of administrations in the U.S., the prospect of inflation. And one thing we can really be sure is that the future is not going to look like our recent past. And given our history of what just recently happened, what question or questions do we think should or will be part of every investor manager's selection process that isn't necessarily one that we've asked in the past? And John, maybe you want to kick this off?
Sure. So thank you. I think the backdrop you laid out very succinctly. It's a very difficult time and interesting time that we're in for a number of reasons. It's interesting. I think from what we've learned over the last year is that a lot of things on the investment side probably can be done certainly differently, hopefully better and more efficiently. As being remote has forced us to really rethink kind of ways that we even, approach operational due diligence, how much face time we really need with managers. And, one of the things we saw early in the pandemic was a lot of large investors were really restricting their investments only to managers that they had met with in the past. And so we saw a lot of money flow really from one large hedge fund manager to another large hedge fund manager, which was disappointing, certainly for a lot of emerging managers who actually navigated certainly the last year and a half really well and maybe had already built up pretty solid track records and were ready to make that next leap. And, a lot of investors were actually frustrated by this. And, they had a lot of internal rules and bylaws depending on, how institutional they were, which restricted them to a lot of box checking and not because at the time when it was created, it was to check boxes, but really kind of, making sure that things in the past, such as what we saw after the financial crisis and the Bernie Madoffs and fraud around there, where operational due diligence was a lot of, not only who's your administrator, but going in and making sure that the servers were actually there. And even now, what does that even mean? I mean, they're cloud-based for the most part. So, a lot of the infrastructure that we would typically find in an office is elsewhere. And so a lot of the questions that we need to answer, a lot of this can be done through phone calls and smart, desk work. And that's something that has allowed investors to, at least in this environment, expand their reach and be able to approach emerging managers, whether they can meet them in person or not. And I think that that's something that we will, it's not going to completely shift and change the way due diligence is done in the future, but it will make it more efficient. And probably for folks that are, oceans away from managers, it may, help speed up investment processes. So I do think there are things that we were forced to learn, just kind of how well we can do just in a remote environment that we will take with us going forward. So that's very high level. I could certainly give more specific things, but I figured I'd start there.
No, fair enough. And I want to get Jeff in because he's also a hedge fund, fund of funds, and he looks for managers and also ETFs. So Jeff, sort of same question here, given our recent history, what question or questions will you be adding to your due diligence as you're talking to managers?
A lot of that process is pretty well established. There aren't a whole lot of new questions. It's to some degree maybe a new process. One of the ways that we're addressing that internally is by moving more into the liquid alternative space. So with that as a backdrop, you actually have a whole lot more transparency. You have a governance structure. You have oversight, not only by ourselves, but by agencies. And so looking at that, I would expect that we're going to see a continuation of that trend within the marketplace, where a lot of that is publicly disclosed. For example, on the ETFs that we've introduced thus far, the holdings are published daily on our website. So investors have a level of insight into what's going on in the portfolios that they probably wouldn't have in the private space. And our focus as the industry continues to mature, I expect that we're going to see a lot more movement into the public environment from the private environment, just to sort of address some of those issues, especially on the part of smaller managers.
Yeah, I guess one of the things that, and I had this conversation a bit with John yesterday, was, a lot of the, what he calls checkbox things really grew out of regulation, right? Do they have this? Do they have that? Because everybody wants to make sure if the SEC comes in and audits you, you've got your answers all lined up and you're ready for that audit. But I think as you're thinking about this, are there areas now that you're seeing right now with hedge funds that is it connectivity to certain prime brokers? Is it how do they do this or that? Are there things you're looking at that maybe say 5-6 years ago you wouldn't have been looking at?
Again, I think there are two aspects. The biggest one is transparency. Managers now understand and are much more willing to disclose holdings on an ongoing basis that 5, 10, 15 years ago would have been non-starters. And as the business has become more institutional, that becomes a necessity. And so that is the biggest trend that I see. And I see it continuing to the point where investors do have full insight into how the portfolio is being managed and are able to see, okay, do we have style drift? Do we have, it's risk management. And
Sure.
All the times that you've seen things blow up largely were a result of things that were happening behind the scenes that were not transparent. And so that is the biggest trend. And I see that continuing pretty much nonstop.
Yeah, I agree. Danye, you certainly deal with cross-border transactions, and so does Dagmar. So we'll get in with Dagmar in a few seconds on this too. But Danye, talk to me a little bit about, particularly Asian investors and, things that might be of interest to them. And particularly, doing cross-border transactions, things you might be diligencing that other people may not be looking at.
Right. I would say historically, similar to just institutional investors, family offices across the board, the three most important elements of, I guess, manager sourcing and selection: pedigree, track record, as well as strategy. I think given COVID and just given the complexity of cross-border due diligence these days, and also the changing dynamics of the investment landscape, I think a lot of family office, either through my direct work or just ecosystem interactions, historically, we think as long as you can generate a proven team, proven track record, and you can explain your strategy well, and you kind of check the boxes, and we can move on to the next stage. But just given the changing dynamics of the industry, I think more and more it's not enough just to say you have repeatable track record. It's important to really showcase it in your strategy. And if the market you're investing has changing dynamics as well, it's also very important to explain the details of your strategy. Not to say that you are style drifting, but if there are certain tail event or a different theme going on in the market, how exactly you're evaluating that and how you might be adjusting given the changing market condition. And I would say if we're specifically talking about Asian family offices, there's I would like to highlight two things that more recently they've been focusing a lot. One is that they're catching up on ESG. I know in the US market, there's a lot of discussion regarding ESG, both in the public and private markets in the recent year or two. And Europe is very advanced in that, but Asia is just picking up. There were emerging managers specifically focusing on this space. There were family offices who started adopting ESG in the due diligence process. So I would say that is one. If you can do really well in this aspect and educate them about kind of the international standard, you definitely are kind of you have a front seat in terms of like getting more access there. And the other thing is Asian family offices love additional resources. So it's not to say it's not possible for them just to allocate to you for financial returns. At the end of the day, they all want financial returns, but a lot of Asian family offices want more market insight, access to co-investment opportunities, or access to direct deals, or some additional value added you can provide aside from just generating returns. And this applied to both public and private. And I think if you are in a position to talk to Asian managers, operational due diligence and an element of ESG as in you're a market leader in this trending environment, and also additional resources, market insight, and maybe access to some direct opportunities on top of the fund access would be attractive to Asian investors. And one last thing I wanted to add is that there's still a lack of talent in the family office industry in Asia, especially China, although the market is big. So chances are you might be, unless you kind of channel through an advisor or a consultant, a lot of times you may not be dealing with a very sophisticated investor. In the US family office space, a lot of larger family offices hire people with a sophisticated institutional background already. But in the Asian family office space, a lot of times the owner would still hire someone they trust, but not necessarily with the institutional background. And people don't invest in things they don't understand. So either you channel the inquiry through a very warm introduction, or you really have to go through a process of education to significantly build that trust. I just want to caveat that.
Yeah, you know, trust is always an important factor in any investment decision. Trusting the manager, trusting the team, knowing that you can rely on them if the things get tough. And you know, the whole thinking back 5, 6, 7 years ago was the only way you could do that is in a sit-down meeting with a person and see the team interact with each other. And obviously, the last year that got disrupted. And you're doing cross-border transactions. So really, how do you build up that trust, and how does that work? You know, in an area, you know, when there's a distance between two parties, two entities, and you know, it's not always easy to get back and forth and do those in-person meetings, even when we don't have a pandemic.
Yeah, absolutely. I would have to say, pick your battle. There are definitely family offices I know from China who would not invest, who not even grant a first meeting if he or she cannot meet the manager in person, either him or her traveling to the States or the manager going into Asia. So there are allocators with that mentality, and if it's the case, then that particular mandate may not be on your pursuit for the foreseeable future. But I guess I had the benefit of growing up in China and came to the States for college. And throughout my career at BlackRock, there's a lot of alumni relationships, either from Yale or BlackRock, have since returned to Asia and either built up their own investment platform or joined significant investment firms. And Also, I'm actually also a startup co-founder myself. So throughout my entrepreneurial journey, I also got to know a lot of owners of businesses who are in the process of either starting their own family offices or have already been allocating their capital either through private banking channels or multifamily offices. So part of it is, I guess, just given my own career development background, I do have the natural connection of language and culture and relationships. And also, as I said, relationship building in Asia, especially China, might be different here in the States. I felt here in the States, a lot of time is merit-based. If you have something to say, if you're really good at what you do, it's not that difficult to build relationship because you have a significant value to bring to the table. When it comes to Asian relationships, it's just purely relationship driven. So it's important in terms of who you know. So in every industry or even in the family office space, you can know one or two very senior or very significant relationship. And from that relationship, you can probably gather and develop 10, 20 significant relationships if you can get one point person right. So I think it's important to really deep dive certain significant relationship and anchor that to build additional relationship. And given pandemic, I haven't really traveled to Asia for the last year and a half, although in 2019, I was back for 4 times. So having a relationship be there on the ground to be my eyes and ears is also very important. But I admit it's tough, which is exactly the reason why people like me, firms like UniGlobe Capital, can provide value to both managers
Perfect.
and LPs.
Perfect. Dagmar, I heard you when you gave your introduction talk about how you're all virtual now in the United States. So why don't you pick up on the same thing? How do you build trust between, entities that are separated by distance and perhaps doing it through Zoom as opposed to in person and those sorts of things?
Sure. Well, I should say we started our program or officially started the program in Europe last summer, 2 months into lockdown in Switzerland. So we've been virtual ever since. And we're addressing, or we approached, or we're able to grow this trust or a question quite differently. I mean, in our program is set up in a way that it is driven, if you will, by our own family office's investment office to back every searcher that we are endorsing. And it is driven by our families, offices or everyone who is working in this program, close network to family offices and to their interest in having more control or more transparency and more opportunity to invest in SMEs in succession, or to have more control over their direct equity or private equity direct portfolio. And so it is really sheer fact of having had already a network and building on that network, both in Europe and in the US, and of course deliveries regardless. And deliveries is we set out with the claim that with this program, every member should be able to build their discretionary portfolio, both industry and geography, very quickly, that every member has choice in the manager or the searcher that they're selecting, and that every member has choice in which transaction they would like to commit their capital to, regardless of their initial backing of the manager. And lastly, that every member has opportunities to introduce into the program transactions that land on their desks and they otherwise would not have been able to pursue, but are now able to introduce to the program.
Yeah, I think the other thing that's sort of interesting to me about your program is you sort of build that trust factor right into it, because they have to go through the 2-step process. First, They have to get selected for themselves and their business plan, and then they have to go out and search and find the company.
Right. So the selection, perhaps if we add on, if I may add on a bit on that selection process, today we're live with a dozen searchers or managers. And to have these dozen managers in our program and being sponsored or co-sponsored, my colleagues screened more than 3,000 CVs or applicants. And these are all mid-career professionals. These are all accomplished managers who have made a decided decision. Well, poor English is that, but I'm sorry. Step out of the corporate ladder where they could have safely remained for the next 10 or 15 years and just done very well. But they have this entrepreneurial edge, plus they have through their professional trajectory, they are aware of SMEs or entrepreneurs in their industry segment, and they know that these entrepreneurs, if they had the right partner, both manager and capital, they would pass the company on, and given that, they will transact on that and pursue that. But when they step up to the transaction a little bit differently than perhaps peers in the industry, because they step up to the owner with a with a closed cap table, with capital at hand, and that makes it different. And the members in the cap table, they interact. It's an open platform, and so there is we already know business and opportunities are being pursued that are outside of our program, but they're not interfering with the strategy that we are pursuing and the advice that we are providing.
Fantastic.
Mm-hmm.
No, that's perfect. I just, one of the things I'm thinking about is we started this whole thing off by talking about, the recent past is not going to be the future, and certain things are changing. For instance, inflation is being, spoken about. Certainly we see food prices, gas, other things going up. And I'm curious if that is impacting how you're thinking about manager selection. Are you looking for different types of strategies, or are you looking for managers that have different type of experience? And, as you think about this, and I don't know, Jeff or John, maybe you want to address this?
I'll take a first shot at it.
Okay.
Obviously, if we are going to a higher inflationary environment, which is still, I think, something of an open question, there are certain strategies that would do better in that type of environment. You sort of switch from financial assets to real assets. And the other part of it is that, much of the growth in the industry, broadly based, has been a function of just price appreciation. And if you're going in an environment where price appreciation may not be as big a factor in total returns, then you've got to look more at arbitrage type strategies or things that aren't going to be dependent upon a rising market. And so that's how I would see the evolution of that piece of, all right, well, if the S&P is not going to go up by 10% a year for the next 5 years, which has been broadly speculated, then things like data-based long-short equity may not be as attractive going forward as they were in the past.
Have you started adjusting at all? Are you staying, or what? Sorry, I'm not asking you to give away your magic here, but sort of give me a little insight into how you're personally thinking about this in your portfolio selection.
Hedge funds historically have been, participate in the upside and protect on the downside. And I think as that business has matured, it's become more of a relative return business than an absolute return business, which means that especially the larger managers have had a great dependence upon that beta component. Our focus has always been back to what hedge funds were supposed to be, as opposed to where many of them have evolved. And so looking at absolute return type strategies or beta-based strategies that do have the ability to protect on the downside. So our focus hasn't really changed that much. We have become more involved in the commodity space and have looked at sort of the overall allocation process where historically bonds and fixed income have been considered a hedge for your equity exposure. The last 20 years, we've seen generally negative correlation between equities and fixed income. But if you go back further than that, that negative correlation was positive in a large number of periods. And so taking that into account as well, we've moved away from sort of fixed income, income-based strategies more into relative return focused pieces.
Fantastic. Thank you for that great answer. John, do you want to follow that up? I know now I'm putting you on the spot. You got to follow Jeff.
No, I mean, look, what's interesting is we've looked at a lot of data and a lot of things that Jeff was saying. I can kind of confirm through the data. I mean, one thing that's really interesting, and there's conventional wisdom on this, and then there's kind of, it gets a little bit more subtle as you peel back the onion. Typically people think rates are high, bad for equities, right? Rates are low, good for equities. And essentially that is true. And I'll give you an example. Going back to 1998, we looked at the data and just taking the S&P 500, when rates are between 0 and 3%, and there were about half the month since 1998 where that was the case, the S&P annualized at 16%. Okay, so that's pretty good. When rates are between 3 and 7%, the S&P annualized at 5%. So obviously just breaking up those two periods, not forecasting, but based on what occurred, huge difference. But what's really interesting is obviously if rates are low right now, and let's use the 10-year as a proxy, and I'm actually, let's think about the 10-year as also reacting to inflation, kind of a market gauge of inflation for simplicity purposes. When the 10-year is rising, so if it's at, let's say 1.5 now, 1.4, 1.3, and it's going to get up to 3% or more, obviously there's a journey there, right? There's a path there. And interestingly, we broke down history over the last 23 years as well. And again, it kind of breaks out. There's about 133 months where the rate itself moves down. When that happens, the S&P is close to flat on an annualized basis. There are 146 months where the rates move up. And when they move up, the S&P annualizes at 21%. So just think about the S&P and the differences. And as Jeff was alluding to, obviously, if you go back further in time, you're going to see some differences in correlations. That being said, hedge funds also have kind of very different stories about when they outperform kind of on that relative basis, as Jeff was saying, and it does really differ by strategies. So, one thing to note is when rates are low, that's not typically good for a lot of strategies in the hedge fund space, specifically macro and managed futures, which a lot of them are relying in part on underlying exposures or underlying collateral that are paying them interest. So they're always returning something on top of those interest rates. So the overall returns are much lower in these low interest rate environments. And again, much higher in these high interest rate environments. But if we kind of come back to, if we expect inflation to increase, which again, as Jeff alluded to, pointed out, it's a big if, we don't know yet. But there are certain strategies, especially that will significantly outperform some hedge fund strategies. So for example, if rates are moving up, again, you want to stay away from probably macro and a lot of the managed futures strategy. You want to be much more in kind of general, but certainly credit, equity diversified. Those typically have worked out really well. And the equity sector strategies in particular, which have been, big performers of late. I mean, just look at that as an example where you have had healthcare and TMT, or technology, media, and telecom, leading the way for the last 5+ years. And in fact, TMT was up over 35% last year, and healthcare was up close to 20% from our indices. And this year, year to date through May, both TMT and healthcare are flat. And while the financials and the energy space have been laggards in the last 5+ years as well, they're leading the way year to date. And so we can just see kind of in that shift of lead versus lag, the type of effect, even just kind of the inflation conversation that's going on can have on strategies. And again, if you drill into any of these strategies, you're going to find that some of them are going to do really well while interest rates are rising. Some of them are going to do really poorly. And you can see it within the S&P. And then again, once rates get to a level and stay there, then the conventional wisdom can kind of come back into play. But that's the kind of work that we do to kind of peel back the onion a little bit and advise our clients on where they want to be based on their views of big things like inflation, not necessarily our views. We have them, but we're not economists. So we want to make sure, given the scenarios, they know how to position their portfolio and then drill into the next level, which are the best managers to affect my investment thesis if I've decided that I want to be in these strategies because of my views on interest rates, inflation, equity performance, and so on.
And Danye and Dagmar, I guess just a little twist on this. That in terms of the families that you represent and the directions, are you seeing a shift and perhaps they're looking for opportunities, or the types of opportunities they were looking for as a result of changes in the market right now? You can
The
take it.
Asian families that I work with, I guess they're less sensitive to inflation, because if we're looking at Asian markets in general, the degree of inflation or even interest rate in general are already much higher than the US. So they're familiar with that dynamic. And also most of the allocators that I advise look at private investment. So they still think that there's growth opportunities from the current valuation perspective. I do want to say that historically, Asian families are very interested in pre-IPO deals. They are still interested in certain names, but they're getting slightly more sensitive to where valuations are and being more careful about maybe their opportunities to re-enter once the company do go IPO and get in from a public market perspective. But for inflation, I just, at least from my personal perspective, I haven't seen as much twist from an allocating or investment strategy perspective just related to that.
How about rather than just focus on inflation, maybe a shift in the market dynamics? I hear you, Marty. I'll get to you in a minute. All right.
Yeah, definitely more sensitive to where valuation are and if they're getting a discount in the private market, and more, and they're also very sensitive to lockup period and kind of the duration of the investment. Typically, Asian investors are not as long-term as US investors. I guess in the industry, there's a saying that it's more hot money coming from Asia and the US is more patient capital. I think more the family offices, especially the bigger family offices in Asia, are getting more sophisticated. So they're becoming more patient as well, which is why they're looking at valuation in a more sophisticated manner.
Terrific. Marty, I'm going to let you jump in there and then we'll get to Dagmar.
Right, fantastic. Great panel, guys. So my first question is for Danye. Can you talk about, this is one of Asian trophy investment. I think some people here are logged in and they have their volume, they should be on mute. But if you can talk about Asian trophy investments, and also just in general for the audience, are you guys looking at any fund of funds in the SPAC space? Because we've seen a couple. Maybe you can talk about that.
Just really quick on this. I would say the last 5 years or so, there's definitely we've seen a lot of trophy asset in the market coming from Asian buyers, and it's not just family offices, but also like insurance companies. I actually walk by Waldorf Astoria every day. That's unbound still; it's not doing too well. I guess in the more recent 2 years or so, there's a significant capital control from China. So you're seeing less and less of that hot money coming into, especially the US. I think from a general mentality perspective, the asset owners in Asia, or if it's a successful owner of a business conglomerate, or if it went down to the third generation or something, there's a significant appetite for them to put their name behind a trophy asset, be it a significant pre-IPO deal or a piece of real estate. So I think that mentality is still there. But I do think, just given capital control, especially from China, and there are certain trophy assets that did not pan out in the recent years, and also the reputation in Silicon Valley from Asian investors can also be tricky on a case-by-case perspective. So I do think you're going to see less of that going forward. SPAC, like there were actually waves of SPAC from Asian investors way before the current trend. It's like 10 years ago. So I do think, so I do think there's a natural appetite for SPAC. I know certain venture investors in China are very actively getting into SPAC deals for their portfolio companies, or getting access to investment opportunities that previously wouldn't be as easy to get an exit. So I do think Asian investors, both family offices and fund managers, are actively participating in this. So if you have a SPAC deal or something, feel free to talk to me, and I'm happy to make some connections there.
Hey, John, do you want to address maybe the for your endowments and your foundation clients, the SPAC fund of funds market? And are you getting a lot of demand for that? Hearing people looking at that, people wanting to jump in that area?
I would say that the answer is no. I mean, the big institutions that we talk to, they know that they're probably getting it from some of their managers. So one area where we've seen, a lot of play in the SPAC place is in the convertible arb strategies. Which isn't necessarily what you would expect. I mean, but so a lot of the performance from convertible arb, which was extremely strong in 2020, the differentiation or the dispersion in that space were really based on the managers that really got heavily into SPACs, and then versus the managers that really stuck to their core strategy and didn't. And it's kind of an interesting thing, and it does get back to, what we talk to our clients about, is that, you want to make sure that when you invest in a manager that they're doing what you expected them to do. And even if it works out really well, that doesn't mean that that's what you're paying them for. And it even gets back to that trust factor, right? I mean, trust is built over time based on kind of confirming and reconfirming things that you expect to happen, or someone following through on something is really the issue. And take that SPAC example in the convertible arb space. It worked out really well for a lot of these managers, but is that where people expected to get that exposure? Is that where they think their expertise is? And that's, definitely caused some of our clients to kind of question those managers, even though the performance was really good. So, long-winded answer of saying that there hasn't been that much particular interest to go directly into SPACs. They recognize that it can be part of various strategies, and so they're opening their eyes more to that. And for those that want to have some of that individual exposure, that's a good thing. For those that aren't really sure that that's where they want these hedge funds putting their capital, especially based on their skill set and experience, they're probably more likely to move away and not reward that great performance from last year.
Fantastic. I'm going to throw, I know Marty's, I'm assuming we have time just for one more question here, Marty, to Dagmar.
Sure. I think you had a couple of questions from the audience as well. So.
Oh, did we? I'm sorry. I did not see those. So while Dagmar is answering this one, I'll be going through these as quickly as I can to maybe shoot them out. So Dagmar, my question for you is when you get to the end of your first phase, you say to the manager, we like your business plan. We like you. We're ready to move forward. What is the deal? I mean, what makes him want to spend the next 6 months of his life looking for a deal? Obviously, I shouldn't say obviously, but is there a commitment of money at that point? Is there funding his expenses? What is the commitment there to that entrepreneur or person to go out looking?
Okay, sure. In the first phase of the engagement with a manager is essentially providing the manager with working capital to seek a company, and that working capital is comprised of, we call them units, and these units are not much more than, if you will, an option to follow through on the acquisition. And during that phase, during that search phase, the manager has to report continuously to his cap table, and every transaction that they're deeming interesting, the managers are deeming interesting to pursue, is being tested, for example, by our M&A team, and we support them on the legal M&A and analysis and whatnot. So that comes to us. But what is really interesting for the co-investors to participate with in a cap table is, again, the opportunity to be really close to where the manager is going, where he or she is seeing opportunities, and whether or not they are following the business plan. Two is an opportunity, again, for family offices to introduce to a cap table transactions that they have on the table that would be perhaps interesting for the manager and for the remainder of the cap table. And lastly, they're in it also to generate return and on their investment. And historically, that asset class has generated approximately 30% IRR over, let's say, 5 years. We have structured our path to exit in a way that, while also in all other search funds, the manager earns a carry when they reach a certain threshold of performance. So their carry vests until exit. We have also structured into our program opportunities for families to offer an early buyout, and with that, if you will, shorten the duration and have an earlier liquidity event, which if you are in the private market is a very interesting opportunity or trajectory for a family to build out a platform which they might have in-house, but they're not buying blind.
Fantastic. Thank you. I've just got to keep this moving because we're down to our last minutes here. Jeff, I'm going to ask you to field this question from the audience, if you would. How do you look at sector-specific strategies or geographies, specific geographies for managers and their portfolio diversification? So,
it
was written more eloquently than I phrased it, by the way.
We're sort of agnostic when it comes to either sector-specific or geographic-specific investments. The world is becoming much more of a global place, so a geographically focused investment may or may not have specific interest to us. It's all based on the same level of factors of, do we believe that there is true alpha being generated in this strategy? And what is the true risk profile of the strategy as well? So, as I said, we're agnostic on that. We're not looking at it and saying, oh, well, we need more exposure to Asia or Africa or Europe, because the markets tend to be relatively highly correlated outside of some emerging market type structures. So it doesn't make a difference to us in that sense.
Terrific. Marty, on our time, how do we stand?
I think we're good. I think we're done.